Hello and happy new financial year. Inside the Tax Roundup this month, we're taking a look at a new residency ruling that could change the status of some companies. We'll also take a look at a case once again on residency that looks at really how hard it is to pass some of the tests to determine whether you're a resident of a foreign country. But first up, Michael is going to take you through the big elephant in the room, and that is the 1 July 2018 tax changes that are still sitting in Parliament. We're going to look at what they are and how you need to respond, given we don't have the law yet. Across to you, Michael.
Now, it's 30 June 2018 comes and goes. There's a pretty big issue that's up in the air for all of our corporate clients. And basically that is what tax rate should apply to companies for the 2018 tax year. There's a flow-on question around that as well, which is, well, if dividends have been paid during the 2018 year, what's the maximum franking credit that can be applied to those dividends, or the franking credit rate? Now, the reason why that's all up in the air is that back in October 2017, the government, in response to some of the uncertainty and controversy around whether a company was carrying on business and who should really qualify for that lower corporate tax rate of 27.5%, basically said, look, we're going to introduce a bill which is going to change the way the corporate tax rate rules are structured. And many of you would remember that what the government was trying to do was introduce a passive income test. If more than 80% of the company's total turnover is passive in nature, as defined, then a 30% tax rate would apply, even though the company's turnover would be less than the $25 million threshold. The problem is that that bill really hasn't gone very far. And we've always thought, well, hoped anyway, that by 30 June, this would all get sorted out and we would have a final set of rules to apply for the 2018 year. As it stands, that's just not the case. The way the rules are written right now is that to determine a company's tax rate for the 2018 income year, you simply look at whether it carries on a business under general principles, and ATO guidance around that issue suggests that basically we're just looking at whether the company is operated with an intention and an expectation of making profits. So does it carry on a business under that pretty low threshold for what is carrying on a business for companies? And secondly, look at the aggregated turnover of the company for the 18 year. Is it less than $25 million? So as the law currently stands, that's how you determine the company's tax rate. If the company doesn't carry on a business at all in the 2018 year, which is probably going to be pretty rare really, then a 30% tax rate would apply. Alternatively, if aggregated turnover for the company and certain related parties is $25 million or more, then again the 30% tax rate will apply too. Similar rules apply for dividends. Dividends paid during the 2018 year. The way it stands right now is that dividends paid during the 2018 year, the maximum franking rate for those dividends will be based on what the company's turnover was in the 2017 year, and that question again around does it carry on a business. So if turnover for the 2017 year was less than $25 million and the company carries on a business under general principles, then the maximum franking rate for dividends in the 18 year will be 27.5%. For all other cases, we'll have a 30% maximum franking rate. But if the bill does go through, well, the expectation is that it will apply for the 2018 year, and we'll have to apply this 80% passive income test, which could mean that some companies could be moved into a different tax bracket. The franking rate, the maximum franking rate percentage, could also change as well if the bill does go through as it's currently drafted. Now, I guess what we need to do at the moment, if we're getting towards preparing company tax returns and this still hasn't changed, well, presumably you'll just have to apply the law as it stands, but keep in the back of your mind that if the bill does pass, well, there may well be a different outcome. For dividends paid during the 2018 year, if we're dealing with private companies, well, there's no strict requirement to determine the franking percentage at the time the dividend is paid. You've actually got until a little bit after year end to make that decision. So potentially it gives us a little bit more time to wait and see whether the bill does in fact pass, and then we can make that final call on what the maximum franking rate might be. Aside from that, who knows? Last year, the ATO was pretty lenient on this issue. Again, given the uncertainty that arose around the 17 year, the ATO kind of said, well, we'll give you a bit of time to make changes given the changes in the law that have occurred. Presumably something similar would happen for the 18-year, but really it remains to be seen. We don't really know at this stage. So it is up in the air a little bit. For some companies, whether we apply the current rules or the proposed new rules, for many companies it probably won't make any difference. So you may well take the practical approach of looking at both tests and just see, would you get the same outcome regardless of which test is applied? Well, if so, you probably have a reasonable level of confidence around what those tax rates and maximum franking rates will be. But for companies where the application of that proposed new 80% passive income test would make a difference, well, you're probably going to have to apply the rules as they stand now, but then keep an eye on developments because you may need to make some adjustments later on. Of course, we'll let you know as things develop, if and when that bill does go through, and what steps need to be taken if that does end up occurring.
And from the ATO, we have that ruling that may change the status, the residency status of some companies.
Now, we've had the ATO finalise a tax ruling looking at the residency tests for companies, particularly those companies that have been incorporated overseas. Now, this is an issue that's been a little bit up in the air over the last probably year or so because of a High Court decision which looked at this issue of corporate residency for companies that have been incorporated overseas. Now, the way the company residency tests work is, first of all, you look at whether the company was incorporated in Australia. If so, it's automatically treated as a resident of Australia. However, if the company has been incorporated overseas, there's a couple of other tests that we need to look at. First thing we need to do is look at whether the company carries on a business in Australia. If it doesn't, then it can't really be an Australian resident. If it does carry on business in Australia, then it will be treated as a resident of Australia if either its central management and control is in Australia or its voting power is controlled by Australian residents. Now, in the past, the ATO took the view that when it comes to whether a company carries on business in Australia, you look at that slightly differently depending on whether you're dealing with an active trading company or a company that just does passive investment type activity. For an active trading company, the ATO took the view that if all of the trading activities were actually outside Australia, then that company probably didn't carry on a business in Australia, which meant it couldn't be an Australian resident if it wasn't incorporated here. Now, that has all changed. What the ATO says is that we need to put a lot more focus on this concept of central management and control. And basically what the ATO says is that if a company carries on a business at all, and the threshold for carrying on a business for companies is pretty low. Basically, if a company is operated with the intention and expectation of making a profit, then it's probably carrying on a business for the purpose of these rules. So if it carries on a business and its central management and control is exercised in Australia, well, the ATO now says that that company will also be treated as carrying on a business in Australia. The fact that it has its central management control in Australia also basically just means it will be an Australian resident. So that concept of central management and control is really important now. If central management and control is in Australia and the company carries on any business at all, then the ATO is saying that it will be a resident company now. Taxed on worldwide income, subject to specific exemptions that might apply for things like foreign branch profits, and subject to exceptions that might exist in double tax agreements. But because of that change in approach, it will really be necessary for practitioners to consider clients who may have companies that have been incorporated overseas. It may be that a view was taken years ago that that company was a foreign resident, and the tax implications that flow from that would be quite different to the tax implications that would arise if that company was a resident. Those companies probably need to be revisited in light of the High Court decision and also the ATO guidance that now follows. Now, in addition to that tax ruling, the ATO has also released a draft PCG, Practical Compliance Guideline, which fleshes this issue out a bit more. It kind of broadens out what's covered in the ruling and really works through a number of examples just to show how the ATO would apply those concepts in a number of practical scenarios. So really is necessary now to take that final ruling and to reconsider whether companies could actually be treated as Australian residents, and then think, well, what are the implications that flow from that? It may well be an exposure to Australian tax in a different way than it has been to date. So pretty key area. Companies incorporated overseas, we may need to revisit that. in light of this new ruling.
Now, residency is something that we all need to be across in public practice, whether it's an individual client or an entity. Michael Carruthers and Karen Velo will be doing a workshop across the East Coast that looks at those very issues at a very, very practical level. It's the typical sort of stuff that most accounting practices do. Hope to see you there.
We're looking at a case this month which deals with residency status of an individual taxpayer. This is the Harding case. And basically what happened in the Harding case was we had a taxpayer who was living and working in the Middle East, but his spouse and children were still living in Australia. Now, this taxpayer had spent a fair amount of time living in Australia, had an Australian domicile, but basically had said that he had no real intention of ever living in Australia again. And it seemed to be accepted that that was a genuine intention. Now, in terms of some of the other background facts here, well, this person owned a property in Australia, and it was basically used as the home for their spouse and children. They spent most of the year working in the Middle East, but did come back to Australia once a year or so just to visit family and have a bit of a catch-up. But the rest of the time they basically spent living and working in the Middle East. Now, in terms of accommodation while living and working in the Middle East, this person stayed predominantly in serviced apartments and did move between different apartments from time to time. Now, the issue that arose here was, well, how do the residency tests apply to this particular individual? And the focus in this case was on the ordinary resides test and the domicile and permanent place of abode test. So, first of all, the court looked at whether this person was residing in Australia under general principles or ordinary concepts, and was actually satisfied that they were not residing in Australia anymore. This person spent most of their time living in the Middle East. They'd broken a number of connections with Australia, albeit they still had a couple of pretty strong connections in Australia, given their immediate family members were living here, and they owned a property that was here as well. But it did appear that this person had the genuine intention of continuing to live overseas and no real intention of ever coming back to Australia. What the court was basically saying in this case was that the evidence suggested that this person had prioritised their work despite the fact that their family lived in Australia. So the decision was made that they were not residing in Australia anymore under general principles. But that, of course, isn't the end of the story. There are 4 tests of residency, and you have to work through all 4. In this case, the other key test was the domicile and permanent place of abode test, which basically says that if you have an Australian domicile, you will be deemed to be an Australian resident automatically, unless the Commissioner is satisfied that you have a permanent place of abode outside Australia. Now, in this case, the taxpayer had an Australian domicile, so really the focus was on permanent place of abode. Did they have a permanent place of abode somewhere overseas? Now, in this case, the court was satisfied that this taxpayer had a place of abode overseas, but they were not convinced that it was a permanent place of abode. And the key reason for that was around the nature of the accommodation that they were using and staying in while overseas. The serviced apartments. The intention, and certainly what actually happened, was that the taxpayer did move from time to time between different serviced apartments. The other key bit of evidence here seemed to be that they really had few belongings that they kept in these apartments, and that enabled them to move pretty freely from one place to another as they felt like it. And that, by the way, the evidence suggested that's actually what they did as well. There were a number of occasions where they had moved everything from one place to another, and they were continually free to do so given the limited possessions that they kept in those serviced apartments. So even though this person no longer resided in Australia under ordinary principles, and they spent most of their time living and working overseas, they were still deemed to be an Australian resident for tax purposes, therefore taxed on worldwide income. So really important case here, because we see once again an example of how difficult it can be for someone, even though they're based overseas on a pretty permanent basis, to actually break that connection with Australia when it comes to the residency tests. It also demonstrates just how important it is to work carefully through all 4 of the residency tests. In practice, we see examples of people who kind of use a gut feel. Oh, this person looks like someone who doesn't really live in Australia anymore. They look like someone who's a non-resident. But we really need to make sure that we're focusing quite specifically on the way each of those tests applies, and carefully look at the facts for our client situation to see how that would basically impact on the application of those tests. So we've seen lots of residency cases go through the tribunal and the courts over the years. Here is yet another example which shows just how complex this area is and stresses the importance really of being very careful when we are approaching residency issues, given it's really one of the fundamental bases of the tax system and has a massive impact on a taxpayer's tax outcome.
And that's the tax roundup for this month, and there is no better time to be a member of Knowledge Shop. We will help you keep up to date, and we will also provide you with the new year work papers and standards that you need to make sure your practice is running smoothly. If you want to see what's on offer, give Julie a call on 1800 800 232. See you next month.